Got heavyweights, JP Morgan and Citi, as Sarah was saying, kicking off earnings season this week. Washington Crossing's Caron joining us now with his view. Kevin, how much more upside is there left in the financials?
Well, there's a lot of room left because the value complex has been so depressed for such a long period of time. And the two biggest components of that would be financials and energy, two groups that have been essentially left for dead in 2020, which was a market all about big tech. And a lot of bifurcation, trifurcation, if you will, among all of the different sectors. So if you look at the S&P in 2020, it was about a dozen or so stocks that led the market to its single biggest dollar gain ever. And you had something like 200 stocks within the S&P that were actually down, with the median company up only low single digits. So this was a very narrow leadership through 2020. The fact that things seem to be broadening out here to include value stocks, energy, banks, a wider number of companies is really a healthy thing. Even though we see the futures down a little bit this morning, it's a good thing to see some broadening out of activity within the market.
Which banks look most attractive to you, Kevin?
Well, we own them through the ETFs. Essentially, Washington Crossing runs a program called Conquest. It's a tactical asset allocation portfolio, and we're going to focus in that portfolio on whole sectors where we don't have to have the risk associated with owning individual companies. So at Washington Crossing, we like using ETFs as a way to get exposure to the sector.
So more broadly, there's a question, though, Kevin, more broadly about this reflation trade and whether this is the start of a new economic cycle. And this matters in terms of how you play it. You took sort of a contrarian view because a lot of people are saying it is the beginning of a new economic cycle. You're saying that doesn't really quite sum up the picture quite accurately. Can you explain your view?
Well, Washington Crossing, our view is that the recession that we had last year, statistically, it was a recession, but if it is, it's one of the weirdest ones we've ever had, because a recession usually involves something of a reset where asset prices fall, and as a result, the forward-looking returns on equities and other risk assets actually goes up, which kind of resets the game, if you will, for another round. We didn't have that last year, as we had, as I said before, the biggest single-year dollar gain in the S&P ever. And if you look elsewhere, if you look at the IPO market, if you look at housing, just Bitcoin, all of these places have shown the weirdness of last year's recession. Narrow leadership, speculation, and a significant portion of the market being moved by a relatively few names. So it really, if it is a sort of a new cycle, it's really a very weird one, and we can't come back into this as if we can just take out playbooks from last recessions and wheel them out again, because we just simply haven't had the reset in asset prices to fuel the next leg in the same way as we have in the past. It's going to be very different this time.
This is a really important point, Kevin, the idea that we never got that reset, that we still have valuations at incredibly high levels. As an investor, what are the implications in terms of how this lack of reset will work into the economy and work into investing? I mean, you think about, for example, all the zombie companies out there that could potentially slow growth.
Yeah. So I think you start by acknowledging what it is and what it isn't. So what we're recommending investors think about is this period not so much as being a new cycle, but really a resumption of the old one, where a lot of the same problems that we had before are still with us. So we have elevated asset prices. We still have issues regarding trade. We still have issues within the economy in terms of equality, et cetera, and a lot of friction out there. So when you put all that together, what we need to see as investors is quality in the companies that we own, because to the extent that there is still a real reset of asset values ahead of us somewhere, and we do think there's more risk in the market than most people recognize. A lot having to do with the fact that there's more debt in the system than there ever has been before, and exacerbated by COVID and all of the fiscal programs that were put in place last year globally. We really are advising caution and investors taking another look at their portfolio, try to keep debt less than about 30% of the capital structure where you can. Look for consistency in cash flow, and try to own companies where at least you're being reasonably well paid to take on the risk. So that's how we're approaching it. It's really a resumption of the last cycle rather than a clearing of the decks and starting a new cycle.